So we spend a lot of time talking about semis, and we talk about some of the things that are most exposed to trade. First, I need to start with U.S. Steel because it's a stock I was more bullish on higher up, and this is a stock that's been destroyed in this last month, essentially the extra leg down. Here's what we've learned from management recently. We got kind of some post-first quarter guidance, and bottom line is actually the flat-rolled segment's actually increasing somewhat. U.S. has seen a small deceleration, but the key for these guys is going to be CapEx. People typically would be worrying about a steel company's balance sheet during an economic downturn. So that's a name I really like, and I know this may sound counterintuitive as we go to kind of war with Asia on everything tech and otherwise, but Tencent. So we talked about Bob. I'll leave that for somebody else. I think Tencent, it's arguably the world's most important tech incubator as we talk about gaming and as we talk about all the other dynamics of social media in that part of the world. I don't really see why Tencent is caught in the middle of a trade war. So if you're a stock picker based upon valuation, Tencent looks very interesting to me.
We've seen this pattern for 2 months now. You get these big proclamations about a tariff or rate cuts or rate hikes or something like that, and then they walk it back, and the market just oscillates back and forth. So in this type of period, you want to have stocks. You want to have a stock picker. You want to be both long and short. So if we're just talking about the long side, look at the stocks that have a decent relative strength. I mean, what is strong right now? The U.S. economy is relatively strong compared to the rest of the world. So you look at something like MasterCard and Visa, levered a bit to the consumer. Even though we saw some retail stocks fall today, their growth rates are still fantastic in this environment. Stocks are going bottom left, upper right. They're very, very strong.
So there's a great opportunity in Alibaba right now. I mean, that stock's down probably 10% over the last 2 months. A lot of concern just because it's one of the biggest weightings in the emerging market index, and people have been selling that off because a lot of investors don't want to own it right now. But basically with Alibaba, you have the opportunity to own Amazon, actually a company that's growing faster than Amazon at a fraction of the valuation. So I think it's a great opportunity to really play the rise of that Chinese consumer, and you're buying at a discount.
Go ahead.
So and another stock we're looking at right now is Twitter. So Twitter, kind of on the flip side, is up 15% over the course of the last couple of months, and we're pretty sure that user engagement is going to be strong at least through the 2020 election. I think that's safe to say. And because user engagement is so strong, that's really helping to offset a little bit of slowdown that they're experiencing with user growth.
You know, when you're seeing the relief that's happened twice now, we had the relief in terms of the tariffs over in Europe with the autos, and now all of a sudden we get this extension now with Huawei, right? So I think that's part of this whole thing too, right? I mean, that's the real story here to what your point was in terms of there's storylines that force us down, then there's storylines that pull us right back up. Look at how the semis today just absolutely were screaming to the upside. Apple, the rest of the techs, were all just screaming to the upside. After yesterday, it looked like they were done for good. I mean, it's amazing. So we're right where we were, and yet the volatility in this little segment has been really, really amazing, Mel. I mean, we're talking about 23 back down to 16, back up to 21, back down to 15. I mean, we have been everywhere. So I think it's going to continue to be very volatile. I think that we're still going to be this news. That's why I do like Twitter as well. But yeah, I'm going with a name like KMI. And the reason I say that is they are just so disciplined. And oh, by the way, Richard Kinder just bought another 300,000 shares just a week ago, again, to add to his buys that he does, it seems like, every couple of weeks. He just continues to buy back. I love the discipline of this company, though, because think back to 2015, they had a dividend of $1.93. They had to cut it. And they have been, since that time, adding back to it. Very disciplined. I think they're doing all the right things. And that's one of these names that I love.